Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I brought in a real special guest, a fellow CMB and a coworker of mine at New American Funding, Roger Stotts, who heads up our servicing division. And the reason I wanted to bring Roger on is because I don't know that a lot of people in the mortgage and real estate space have a lot of exposure to what it is that a servicing division at a mortgage company does. What are some of the differences between companies that service their own mortgages and don't? And there's actually quite a bit of confusion when I talk to people thinking that because you service loans, that it's the same as like being a portfolio lender, that you're actually retaining the mortgage-backed securities yourself, or that you're securitizing those and somehow holding them differently like a portfolio lender might do. And I want to explain some of those differences, and who better than Roger to come on and help us unpack this conversation. So Roger, welcome to Market Shares. Thanks for taking the time to chat with us today.
Thanks, Tony, for having me on.
Yeah, very cool. So maybe just a quick little bit of background. I know that you're a CMB, and I was really excited, when we first met, because for me, that was a huge process. So obviously you've been in the mortgage business for a long time. How long have you been doing mortgage? How much of that has been in the area of servicing, just to give us a little bit of background on yourself?
Sure. I've been in mortgage for about 35 years total. And I've had the opportunity to do a lot of different things in servicing. In mortgage in general, mergers and acquisitions, operations, many things. That the last 10 years, I've been focused in servicing with New American Funding. So probably over half of my 35-year career has been based in servicing.
Got it. And did you come to New American Funding when they were in the process of starting the process of retaining their servicing on loans?
Yes, 10 years ago this May, I think a little earlier than that, Rick and Patty Christie decided they wanted to bring servicing in-house. It was currently being done at that time by a subservicer. And quite frankly, the biggest reason for Rick and Patty and Christie wanted to bring in the servicing was to make sure we had better control of how our customers were treated. It was all about how the customer is treated. And none of those really knew much about servicing. So I've had the opportunity to not only learn a lot myself, but also be able to teach those guys about servicing and, why it's such a good tool for us at New American Funding. And so we built it starting 10 years ago with about 20,000 loans. 99% of our book is self-originated by New American Funding, and we're up to about 260,000 loans at about 70 billion in UPB.
Yeah, and I think that's really unique. I mean, there's a lot of sub-servicers out there, or even mortgage companies that have acquired servicing books as part of their growth strategy. And some of them I know specialize in acquisition of default servicing. So servicing that's, in some level of default, and the goal is to help get those caught up, or maybe, short sell some of those. There's a lot of that. And what I see from a customer service perspective, and what I love about the way that we have this set up, is every one of these is a client that one of our loan officers originated. So it's almost like it's more special of a relationship versus some servicing centers I feel like are almost like, collection centers, right? Because they're used to dealing with so many customers that might be, other people's business or whatever the case may be. And we can maybe talk about the ventures into subservicing in the future, but I really like that about the fact that our whole book is every one of them is a client that did their loan with New American Funding, and that's really unique and special about the setup that we have in particular. I'd like to ask you this: if you're thinking from the perspective of a company like New American was 10 years ago before you got here, what are some of the main reasons and/or challenges that you might have if you wanted to start retaining servicing?
I think the biggest barrier is investment. It's quite a hefty investment to, get a system in place. Building it from the ground up is very, very expensive. And there's a lot of the conversations I had with Rick and Patty and Christy in the early days is the expense. However, what I will say is, they did it right. They weren't scared from the expense. The customer experience was so important to them, and they spared no expense. I mean, if we needed it, we got it with technology, with people, and it's allowed us to, as a company, to service the borrower the right way, in our opinion. So we spent a lot of time. We built it the right way. We didn't have a lot of. The nice thing about building it from scratch is you don't have a lot of bad habits. You don't have a lot of problems you got to fix or that you inherited. So it was great to have it, a clean slate. It was difficult in itself and starting from a clean slate, but I would never do it again another way, except to build it from the ground up, because if it's something, if it's a problem, you probably caused it, so you can have the responsibility to fix it. You can't blame it on somebody else. But it's been a long learning process. You talk about servicing for portfolio versus. I mean, we basically have about, if I had to guess, about 7 or 8 bosses, if you will, and I would refer those as investors: Fannie, Freddie, HUD. You got VA, you've got USDA. Those are the guys that make the rules with regard to servicing. We really just follow the rules. I mean, we are driven by investor requirements. We're driven by investor whims and what they want to do in a delinquent market, what kind of service they want to offer. If you go talk about COVID, we had plans for everything. Every type of loan that we service had a different plan. And so that led to, in the middle of, being, forced to leave the office, we're also every day trying to figure out how we're going to service customers and offer them the opportunities for forbearance, for keeping their property. At the height of COVID, we had about 14,000 loans in forbearance plans. And since, obviously we're down to basically nothing today, but, getting those guys into the right plans, getting the right documentation, making sure they understood what they're signing up for, because quite frankly, forbearance was not a gift. It was a deference, if you will, of principal balance and payments, which is what they only thing that they needed. Their job had stopped. Their hours had been reduced. They worked in restaurants where they didn't have a job anymore. There's a lot of things that happened. And so, forbearance was a great deal for most of these homeowners. We had people getting in forbearance that didn't lose their job, but they needed a safety net just in case they did next week. So there is a lot of, and as we move forward now, post-COVID, it's really, the model is set out there for the agencies, for the investors. The model is already built. Why aren't we offering these alternatives all the time? Is what they're saying. And so a lot of them have moved to programs that, we're not waiting for the next COVID. If you need help, we already have the plan available. So we've learned from COVID from that standpoint of what borrowers need, and it's in the best interest of the borrower, and quite frankly, in long term, it's in the best interest of the investor.
Yeah. Well, so it sounds like in the early days, it's really you're starting a whole nother company, right? I mean, you're starting a servicing company. And so I don't think if you're in the mortgage space thinking about servicing, you can think of it as, oh, it's just another thing that we will offer. It's really like starting up a company from scratch. And that's what I heard you say was really the biggest challenge and the biggest financial investment. I think there's another huge financial investment that people don't realize, and maybe you don't see it as much on the servicing side, but when you think about the total value of the mortgage as an asset on the secondary market, a decent percentage of that, let's say around 25% of the value of that asset, if you're thinking of the mortgage as an asset, is the servicing value of that loan. And so if you're a mortgage company who is looking to, originate loans, and then you're going to sell those loans on the secondary market and retain the servicing, well, that means that you're making an investment again in the right to service that loan, which is really only about 25 basis points per year is what the revenue is from Fannie and Freddie. And I know it varies for different product types and different.
It's an income stream. And then that's really, you're foregoing by retaining servicing versus selling it at closing or servicing release. You're getting income then if you sell it right then, but you're creating an income stream if you retain servicing at closing. So I think that's the forethought that Christy and Rick and Patty had. Is like, okay, let's create something that will continue to give back and sustain companies when origination may be down and the income on that side's not there. So it was a good decision. I think the other thing that I would bring up, and this goes directly to origination, people like to know who they're doing business with. Customers out there, they don't, and we just saw marketing information the other day, that said customers want to know who their servicer is going to be. They don't want to be sold, after they close the loan. Now all of a sudden they get transferred to ABC Mortgage and they don't know anybody there. They don't know anything about them. And so it's important as far as a tool and tool belt for our originators at New American Funding. It says, hey, your loan's going to be with us. I'm still here. You can reach out to me. And we have an amazing amount of, servicing questions come up through our loan officers, on behalf of the customer. So it's exciting to see that, the involvement, by loan officers to say, I want to help make sure they help the customer. They're going to hold their hand. They're going to get them to the right person. They're going to make sure that the issue is resolved, and they're going to follow up. And that's exciting because it is, I think, an asset to the originator to be able to sell that as a service to the customer. You'll stay here with us.
Yeah, I have to imagine you guys probably hear about some things that maybe a borrower wouldn't otherwise call their servicer. It's on their mind, it's a concern, but because their comfort level reaching out to the loan officer, it then gets funneled back to you, and then you guys can proactively address it. I think that leads to a better customer experience, and you probably hear about things you might not have otherwise heard about from the average customer.
It is certainly a different perspective that sometimes we don't think about in servicing, because if you think about it, and servicing is pretty cut and dried. I mean, there's regulations out there for everything. So there's not a whole lot of play and a lot of, things that we can do differently than what the investor says. We don't get a lot of leeway, but we do learn a lot about, our constant communication with the borrower, because we get asked, I get asked by investors and auditors about our delinquency rates, and we're relatively low compared to the industry. And our key is communication. And that's twofold. It's communicate often, but the biggest thing is really trying to figure out, for us, if you look at our, customers, we have everything from baby boomers to Gen Z to whatever is next. We've already got them. So if you think about it, we focus a lot of time on figuring out the best ways to communicate with all those different age groups. And whether they want to talk at 2:00 in the morning to a bot, do they want to do, be able to just do email at 2:00 in the morning, get the answer? Do they want to call in and talk to you? And, figure out which group I'm referring to that want to call in and talk a lot. And so they want to talk the problem through and understand it. You have to be able to communicate in multiple ways. And so that's been our biggest challenge, but also our biggest reward, because we have been able to do that and do it pretty well. And so we have email campaigns, we have texting, we have, phone center, you can go into the IVR and do it yourself. There's a lot of things. And is there things that we're looking at on the horizon? Chatbots. We're looking at figuring out how to exactly, to figure out, how do we want to incorporate chat into our system, into our process. And we will be incorporating that. We're just trying to make sure that we do it the right way. So we're not in a rush to do it. We just know it's wanted out there. So we're trying to figure that out.
Yeah, well, I think that it obviously shines through, Roger. I mean, I think it was 2022 when you guys won J.D. Power as the #1 servicer in the mortgage industry, and that only comes from a real focus on customer service, right? And for a servicer your size, that's super impressive. And
it may shock you to know, though, even in our responses for our, on the servicing survey, when we do JD Power, we get a lot of responses that really point back to the origination process. And we get a lot of high marks, in servicing, even though that may be due directly to how they were treated in the origination process, because that left a good taste in their mouth. Yeah. One of the things that we focus so much time on, and it made me the proudest when we won the JD Power Award, is the high score we received on trust. Trust. If you have the trust of the customer, you can get forgiveness if you do something wrong. If they don't trust you, the moment you do something wrong, it's like they want to peel back 12 different layers to understand why you did it wrong, because they don't trust you, because they don't want to do it again. We have scored very high in trust. And so that's very important to me and my entire team, is to continue to rank high in trust. Trust cost us nothing. Just do what you tell the customer you're going to do. It costs you absolutely nothing. So, there's all these other things we can invest money in: technology, processes, redoing, hiring more people, but trust really costs you nothing. Just do the right thing.
Yeah. Well, let's talk about the biggest challenges right now in the servicing industry. We were talking offline earlier, and you had mentioned, and I don't know if this is the biggest problem, but one of the challenges is just the cost of servicing continuing, to go up. Maybe expand on that. What you guys are doing to to try to drive that cost down, and what other challenges are you seeing today in the servicing world?
I think some of the biggest costs that we have been able to be maintained by quite frankly finding the right business partner that's going to invest in technology that for our size they do it for multiple companies. If you look at an insurance provider, they invest a lot of technology in getting bills and paying bills and insurance premiums every year. We couldn't invest in that kind of technology just for ourselves. So it's really gone there searching and finding the right business partners to reduce your costs, because they certainly can do it less expensively than we can do it for ourselves. So we do that a lot. We also look at from the standpoint of self-service for the customer. If they do it themselves, it's like sacking your own groceries or weighing your own fruit at the grocery store. The more I get you to do or get someone else to do, my costs are less. And so I've used that analogy many times, but there's a lot of customers that really, when I go to the grocery store, I love weighing my own produce and sticking the sticker on it and going through the self checkout line. So I just did all their work for them, and I feel good about it. So if a borrower can get the access to the information that they need, when they need it, how they need it, and understand it, they will do it. They would prefer to self serve. So we're looking for those opportunities to provide them with the ability to self-serve. So that's going to help us drive costs down. People are our greatest, asset and our expense. And so, we have to be careful on hiring. We have to be careful on who we're hiring. COVID taught us a huge lesson. Prior to COVID, say if you let, 2019, 2020, I've been doing servicing a lot of years. I would have told you we can never do servicing in a decentralized fashion. Well, guess what? Today, about 52% of our servicing staff, don't even live in Austin, Texas. And so prior to that, it was less than 1%. Did not come into the office every day, did not, participate, in person every day. Now we've got 52% of our staff that don't even live in Austin. They live in, I think we're represented in 15 states now with people. So that's, being able to hire experienced people that are productive quicker also saves us, on the expense side as well. Some of the other things that were, challenging for the past year, we talked earlier about assumptions. Who's done an assumption in the last 30 years? Nobody.
Right.
The entire market struggles with it. Now you've got every disclosure in the world that have to go out. It's treated just like a newly originated loan.
Let's pause on assumptions for a second, only because I think there's people that may be listening that don't know what an assumption is, and I did want to touch on this because there are certain loans that are assumable by a new borrower who might be buying a home. They can assume the underlying loan, and obviously that's super relevant to your point right now, because with interest rates for many years, below 4% for a lot of years, and even in the high twos for a small period of time after COVID, there may be a lot of interest in acquiring that existing loan from the customer and maybe paying cash for the difference, because there's probably going to be some equity in the home that needs to get bought out. Okay, so I just want to set the groundwork that certain loans are assumable. And correct me if I'm wrong, I'm only aware of FHA and VA loans being assumable. Is that correct, or is there any other products that maybe could be assumed?
Technically, not even technically, realistically, we can do assumptions on Fannie Freddie products as well, but only in certain situations. And we call them the 3Ds: death, divorce, and default. Can we do an assumption on a Freddie or Fannie loan? So there are cases to do it. It's a little more difficult, but yes, it can be done. We don't get that many requests for those, but we do obviously get a lot for FHA and VA loans.
But a standard performing Fannie Freddie loan cannot be assumed just by the average buyer looking to buy a home, correct?
Just because they want it to be assumed, there has to be one of the 3Ds involved.
Okay. Okay. So now let's talk about the process. If someone does find a home, it's got an underlying FHA loan on it. Even though there may be mortgage insurance on it, like because it's FHA, the rate could be so low that it's worth the assumption process. Maybe at least at a high level, like, is that something that if the loan's serviced by New American Funding or whomever the servicer is, they would reach out directly to the servicing department to handle that process then?
Well, the person that we reaching out to us is the current owner and say, hey, I have a buyer, because the buyer really has no, if they're a third party, we can't really discuss anything with them. So it would be the current owner that reached out and says, hey, I have a potential buyer. Can you send me the package of documents that have to be completed either by them or by us, well, the borrower and the buyer. There's different information, obviously, as the buyer. We need financials. We need all the stuff you would get in a newly originated loan. Um, so that's the most things that we need. But the current borrower would initiate that conversation.
Got it. So if someone was looking to sell their home and they had really good terms on their current loan and they wanted to see if it was assumable and get kind of prepared to be able to offer that maybe as part of their listing package, they would reach out to their servicer and they could start that process with them. And
And until they have an actual buyer, then that's when the meat of the work would get done. And I think the biggest issue, that we see with those types of assumptions, and you mentioned it earlier, is the upfront cash required by the buyer to buy out equity, because everybody's got equity now. So
right.
yeah, everybody wants a big check, and until they can get settled on that, that's part of the transaction we don't get involved with, because that's settled between those guys. And all we're here to do is to make sure that the terms of the current loan are transferred to the new borrower.
Now, does the new borrower go through the same approval process? Does that loan get underwritten for capacity and credit and all that stuff, just like you would if you were
Because we gather all the information like, say, a loan processor would. We gather all the documents, we ship that package to underwriting, and then they do their thing and then tell us approved, not approved. So we
got
don't
it?
get into the specific qualifying requirements, but yes, it goes through just like a new loan.
Okay. Well, I'm glad we touched on that because there are a lot of questions that come up about that, and it sounds like it's a possibility. So if you're selling a home, and you want to know if the loan you have is assumable, it's got great terms, might help you market your property. Reach out to your servicer, check in on that, and then okay, I want to touch a little bit on the regulatory environment. Now, I don't know a lot about the regulatory changes that came into play. Like I remember back with Dodd-Frank, that was such a wide sweeping regulatory piece of legislation. And, those of us on the mortgage origination side, we think about loan officer compensation changes and a lot of these other changes, the changes to QM mortgages and what was available as far as, adjustable rate mortgages and prepayment penalties and all of those things. But there was also some pretty, I think, pretty wide sweeping rules around kind of shoring up servicing practices. And I personally have to believe that really got us prepared for, dealing with COVID when so many people, had the challenges like you discussed. But how's the regulatory environment today? Is there pressures there? I mean, is there lots of auditing happening more than normal, or what's the current regulatory environment someone would expect in servicing?
Well, inspecting servicing to get audited every month by somebody. I mean, quite
Okay.
in your state or federal, we're audited every single month by somebody. So that's going to happen. That has continued to happen, and we've been fortunate. We have a really strong compliance team that prepares us for audits and puts together all the information. So we've never had an audit issue to this point. So I'm not going wood. We've never had an audit issue. I think that the biggest thing that we try to do, as far as it kind of goes to New American Funding's premise on why we service at all, is to make sure the borrower is taken care of. Did they get every option they possibly could to avoid a foreclosure? And that's usually the biggest driver, is did you offer every option available? So most mortgage companies that have always been doing that, and then when COVID rolled around, even more options were available. And I talk to people, and it's like, I'm not sure how we foreclose on anything anymore, because the borrower has so many different options. I mean, literally, it does happen. But it's, it is, our foreclosure numbers are way down, just like everybody else. We saw a little uptick But again, everybody, if you start with the premise that everybody has equity, then sell the house, you can avoid a foreclosure. Get
Right.
your equity up. That may be, there's a waterfall of multiple items that the process we go through before we ever get to the, to foreclosure. And so that, we continue to add to that waterfall. Every investor continues to add new options, partial claims, we have, monies that we can set aside and the funds that we can pull from. You got half funds from the states that, they have funds that the borrower can request money to make their payments, and we turn the borrowers on to these programs. We talk to someone from California. Here's who you need to contact it at the California Half Funds Department and see what they can do for you. So we use that method with regard to recapture or capturing some of those half funds. I mean, in the millions of dollars that borrowers have received to help make payments and get them back on their feet again. So delinquency for the last 2 to 3 years has been really, really low, and I would say really, really low from a national basis. Less than 5%. Now we're ticking up close to 5%. Yeah, we are. But again, what helps us with delinquency, keeping it low, is all the different options available to borrowers. We don't, um, as no one else does either. You don't go to foreclosure. You don't take foreclosure you take it very seriously. You don't take it lightly. You can, by law and by regulation, there are so many different options that we have to document that we offered to the borrower before we would never get to foreclosure unless all the boxes are checked, that we did every possible thing to get to that borrower and get them the help that they needed. And the key for us is communication. Everything from, phone calls to text to FedEx, deliveries. Like, hey, we really need to talk to you. The ones that,
Yeah.
do to go to foreclosure these days are ones that don't talk to us.
Well, that's what I was gonna say. I mean, I think a lot of borrowers, when they get into a tough situation or they can't make their mortgage payment, their first thought is to kind of, kind of pull back, kind of hide out, like, act like there's not a problem. And what I hear you saying,
They're saying they're embarrassed.
yeah, exactly. I understand that. But it sounds like what the number one thing they should do is be proactive in their communication with their servicer, because there is help out there and there are solutions that you can help them work through.
Yeah, and believe me, the servicer is trying to contact you. I mean, because, again, first of all, we're required to, and we want to do the right thing. There's this misconception, I think, out there that we want to foreclose homes so we can own them and make money off of them. That's not true. Rarely is there ever money in any foreclosure, because costs have increased and repair costs. We are but the third party that's on behalf of the investor. When we take a home, in foreclosure, it becomes an REO for us. We 99 times out of 100, we're turning that property over to the investor. We don't participate in the marketing of the REO. We don't participate in anything that's returned on that REO. We have no interest in that property from that standpoint.
Yeah, interesting. Well, there you go. If you know someone who's in, trouble with their mortgage, it's not like hiding from, a collection agency on some old, collection you have or charge off or something. I mean, it's really important to communicate with your mortgage company, and they can help you and they want to help you. It's in everyone's best interest to help. So don't hide, communicate. I love that. And I'll just say, Roger, as we kind of wrap up here, working at a mortgage company for me that has, a servicing asset, and we think about the current environment that we're in, the challenging market that we're in, I'm so thankful that the investment was made years ago to decide to service loans and forego some of that instant gratification of the service premium on those loans for that longer term investment, because man, it sure provides for a lot more stability of the overall organization in a market like this, where, like you said, the origination business is not great. And I remember Rick saying years ago, yeah, it's expensive to service, but it's one of the very best hedges that you could ever have in place against a downturn in the origination market. And boy, has that played out to be true. And I got to say, when you think about I don't always have, people from departments like yours, on this podcast, but, servicing is such an untalked about thing. It's been so valuable. And every time I interact with you, every time I reach out via email or a client or one of my loan officers has a problem, I mean, you are Johnny on the spot to help out. And I know that that's the culture of your whole division, the whole department there. And so I just got to say, thank you for the support that you provide. And really, it's great to know that if you originate a loan, that it stays within your family, and you're going to have New American Funding employees, at least in our case. And look, this isn't a New American Funding commercial. It's just we both happen to work there, and I think that servicing is such a huge asset. But regardless of what it is, to know that who your customer is going to deal with for years into the future after the closing of their loan, that means something. We all in mortgage. On mortgage and real estate, which is who watches this podcast, we talk about clients for life. These are our clients for life. And then we originate the loan and we sell it, like the next day. It's like, well, they're not our client for life. I mean, and so this just brings a different element. And I'm so thankful for you taking the time to come on and just share some of these insights. I think it's a part of our industry that not a lot of people know about. So thank you for taking the time today. Maybe in the future, if there's any major events that happen around servicing, or, it'd be very interesting. Like, we had COVID. If there's any big stuff like that, Roger, I'm going to reach out to you and give insight for our viewers, because I think when there's big things that happen, maybe if there's a significant change in the economy, maybe we see defaults really go up. I'm going to reach out to you and say, hey, what kind of advice are we giving to people in times like this? Because there may be those situations in the future. So thank you for taking the time. For those of you watching the episode, thank you for always turning into Market Shares, listening to what it is that we have to share. I think this is an interesting conversation. I hope that you felt the same way. And if you want to check out our next episode, it'll be Friday at 10 a.m. Pacific time, every Friday at 10 a.m. So please subscribe to make sure that you catch the next episode. Roger, thanks again. And to all of you, take care.